Question 16. What are its advantages and disadvantages of acceptance rule? Answer. The advantages and disadvantages are as follows. Until the offer is accepted, the offer can't be said as complete, so it provides a security which brings the attention of the contract into existence at the moment of acceptance. Advantage of it is that when the offer of acceptance is being made and the receiving party sends the confirmation to the party which sent the offer, then the offer will be considered as valid. The disadvantage of it is that the offer can be terminated or rejected on the part of the person who is offering the offer, so it is totally dependent on the offered rather than the person who is involved in it. Another disadvantage of this is that if the offered rejects the offer, then offered can't be accepted at future time. Question 17. What is capital budgeting? What is its importance? Answer. Capital budgeting is a process-making system which is used to select and evaluate long-term investments, that is, fixed assets investigation. It requires initial outlay and it also expects to produce the benefits and result over a period of over a year. The importance of capital budgeting is that the proper decision can be made after seeing the capital budget increases the firm's value and also the shareholders' wealth. It is a critical measuring tool for a company which helps the firm to stay in competition as the expansion of the business takes place, for example, purchasing of equipment to produce additional and new products. Question 18. What is the process of capital budgeting? Answer. The process of capital budgeting involves long-term investment generation where they are more consistent with the long-term objectives. It estimates the incremental cash flow which has been a proposals given to the project which has been considered after taking tax. After this, the cash flows estimations takes place and then selection of the project takes place which maximize the shareholders' wealth. Question 19. What are the exit routes available to VCF? Answer. The exit routes of VCF are as follows. Trade sale. It is a sale of shares and business assets which has been invested by the investors and the assets are of the investee. Company uses by the way of private sale agreement. Initial public offering is used to publicly share the offering which will be followed by the listing of shares on stock exchange. Recycling. It is a sale to the sub-investors which are working under the investors or other equity houses. Company buying back the shares. Question 20. What are the different types of venture capital financing? Answer. The different types of venture capital financing depends on the investment of specific purpose within the life of target company, as the high return rate of the company remains constant and it has no effect on it. There are three types of venture capital financing. Early stage financing, which is divided into three parts of its own. They are as follows. Seed financing. In this, small amount is required for the purpose of starting up the loan. The amount which is been used in this is received by the entrepreneur. Startup financing. In this, finished developed products and services are given to the companies, as this can also be used under the initial marketing where the development of products and services takes place. First stage financing. In this, companies which has spent all their starting capital and which are requiring further finance to begin their business activities at full scale are used. Expansion financing is also subdivided into three parts, namely as second stage financing. In this, companies begin their expansion. This is also termed as mezzanine financing, as it is used for the purpose of providing the assistance to a particular company to expand the company. Bridge financing. Third stage financing. Acquisition or buyout financing. In this, acquisition and management finance are used, which assist the company to have certain parts or entire company under themselves. It is also termed as leveraged buyout financing. This also helps in the management group to obtain a particular product from another company by collaboration. Question 21. What is venture capital? What is its importance? Answer. Venture capital is a capital which provides high potential interest generating returns from the growing companies at very early stages. The return which will be generated is through the sale of the company. This term usually generated from the institutional investors and high net worth individuals which has been working together on our dedicated investment firms. The main importance of it is that it generates high interest returns at very early stages and at a growing pace. It also has high-end companies which supports it in reaching the peak. Question 22. What are the provisions of buyback of shares as per Companies Act 1956? Answer. The provision of buyback of shares as per Companies Act 1956. The shares must be bought by the company due to following reasons. They are as follows: promoters holding increment and increment in earning per share, support of share value, and to pay surplus cash won't be required by the business. The resources which have to be used in buyback can be purchased from free reserves. In this company purchase its own shares out of the left out. Then by doing this, sum equal to nominal value of share which has been purchased gets transferred to the capital redemption reserve security premium account. In this company can't buy back its own shares or other security related issues. The buyback period by which it has to be finished is within 12 months from the date of passing the case. In this also the company is not liable to directly or indirectly purchase its own shares or other securities issue. Question 23. What are the advantages and risks associated with secured premium notes? Answer. Secured premium notes are issued with the warrant which is kind of detached. This can be redeemed after a notice period of 4 to 7 years. This way it ensures the holder right to apply and get the allotted equity shares. Secured premium notes has lock-in periods during which the interest is not necessarily to be paid for the invested amount. It also has many options to do the sell back to the holders at par or face value after the lock-in period. As in this only, it contains lots of risks as the holder gets one equity share after a fixed period of time. Question 24. What are the advantages and limitations of credit rating? Answer. The advantage and limitation of credit rating are as follows. People with good credit will have their ability enhanced for the borrowing. Lenders will be able to rewarded or punished by the people with their reports on the habits of their credit responsibility. The limitation can occur when the credit information which has been reported or when the identity of the consumers is stolen. It is really difficult for the lenders to get the information if it is lost, or it is very difficult and exhausting process. Question 25. What is credit rating? What are its main features? Answer. Credit rating is the rating which gives the estimate of the individual company, corporation of country's worth. Credit Bureau makes an evaluation of borrower's credit history and then according to that the actions on it take place. Credit rating shows the ability of the borrower to pay the debt to the lender on request to the Credit Bureau. The calculation of it depends on the financial history, current assets and liabilities. The probability of a borrower to pay back of its loan can be seen by this, which tells a lender or investor about it. The main features which are involved with the credit ratings are as follows. It is used to estimate the worthiness of the credit for the company, country or any individual company. Credit rating is been done after considering various factors such as financial, non-financial parameters and past credit history. The rating which gets done is simple and it facilitates universal understanding. Credit rating also makes it widely accepted as the symbols which are used are generalized and made common for all. The process of credit rating is very detailed and it involves lots of information such as financial information, client's office and works information and other management information. It involves in-depth study. Question 26. When is credit rating obligatory? Answer. Credit rating is obligatory when the lenders need to share some information about you and it has also been done to protect their interest that the client will one day repay the loan. In this what happens is that all the lenders remain in the sync with each other and keep the information of the client with each other so that they can share the information together, because if a lender gives money to the client, then tomorrow if another client gives the money to the same client, then it becomes difficult for the client to pay it off the loan which has been taken, so they both can collaborate together to prevent this misunderstanding. Question 27. What methodology does CRISIL follow for credit rating? Answer. CRISIL is a methodology of the credit rating which reflects its current opinion on the likability of the payment of interest and principal. This methodology is an unbiased, objective, and independent opinion which is designed to meet the financial obligations of the issuer. This methodology includes non-convertible debentures/bonds, commercial certificates, fixed deposits, debt and loans. It is based on clear and robust framework which ensures the standard, comparable and effective communication of ratings which are assigned. Question 27. What methodology does CRISIL follow for credit rating? Answer. CRISIL is a methodology of the credit rating which reflects its current opinion on the likability of the payment of interest and principal. This methodology is an unbiased, objective, and independent opinion which is designed to meet the financial obligations of the issuer. This methodology includes non-convertible debentures/bonds, commercial certificates, fixed deposits, debt and loans. It is based on clear and robust framework which ensures the standard, comparable and effective communication of ratings which are assigned. Question 28. Which agencies are authorized to perform credit rating in India? Answer. There are many agencies which perform credit rating in India. They are as follows: Ownacre Credit Rating Agency of India Limited, Credit Rating Information Services of India Limited. This company provides the credit rating information about the companies and allows giving the worthiness of a company and corporation. Question 28. Which agencies are authorized to perform credit rating in India? Answer. There are many agencies which perform credit rating in India. They are as follows: Ownacre Credit Rating Agency of India Limited, Credit Rating Information Services of India Limited. This company provides the credit rating information about the companies and allows giving the worthiness of a company and corporation. Question 29. What are the advantages and risks associated with deep discount? Answer. Following are the advantages. 1. In this, the bond it doesn't require any assistance of brokers or underwriters because of their inexpensiveness and their consumption of time. For risky business, private placements might be the only source of capital available. Picking of the investors with the specific goals and interest is the job of this kind of bond, as it also enables small business owners to choose for the same. The risks are as follows. Investors in this case will have difficulty in locating themselves as they might be having the limited funds to invest. Private companies place the securities and sell them below their market value or on deep discount. Question 29. What are the advantages and risks associated with deep discount? Answer. Following are the advantages. 1. In this, the bond it doesn't require any assistance of brokers or underwriters because of their inexpensiveness and their consumption of time. For risky business, private placements might be the only source of capital available. Picking of the investors with the specific goals and interest is the job of this kind of bond, as it also enables small business owners to choose for the same. The risks are as follows. Investors in this case will have difficulty in locating themselves as they might be having the limited funds to invest. Private companies place the securities and sell them below their market value or on deep discount. Question 30. Explain the advantages and risks associated with equity warrants. Answer. The advantages of equity warrants are as follows. Through this warrant, a holder can buy and sell the securities and shares in the market. Prices of these warrants are low, so the leverage and the gearing which it provides is high. Due to these prices, there are larger capital gains and losses. These warrants can offer gains and protection in the market. The risks of it are as follows. The high price of leverage and gearing of warrants is not good for investors, as they have to take more losses than gains as the percentage of loss of the warrant increases. The risk which is involved with the value of the certificate which will be provided is that the certificate value can drop to zero, due to which the warrant may lose the redemption value. Holder can't have the opinion in voting, shareholding and dividend rights, so the holder becomes isolated in overall functioning of the company, but the holder is affected by the decisions which will be made by the company.